How to calculate and interpret maturity gap. Maturity gap analysis is a crucial tool for financial institutions to manage interest rate risk. It helps them understand the difference between the maturity of their interest-earning assets and their interest-bearing liabilities. In this video, we will learn how to calculate and interpret the maturity gap. What is maturity gap? The maturity gap measures the timing difference between rate-sensitive assets and liabilities. It tells us whether a financial institution is exposed to potential losses or gains due to changes in interest rates. A positive gap indicates that more assets will reprice before liabilities, leading to potential earnings. Conversely, a negative gap indicates more liabilities will reprice before assets, which could result in potential losses. How to calculate the maturity gap? To calculate the maturity gap, follow these steps. For example, let's say a bank has $1 million worth of assets maturing within 1 year and $800,000 worth of liabilities maturing within the same period. The calculation would be $1 million to $800,000 equals $200,000. This positive gap suggests potential earnings for the bank. List all the interest-earning assets with their respective maturities in one column. List all the interest-bearing liabilities with their respective maturities in another column. Subtract the total value of liabilities from the total value of assets. If the result is positive, it means there is a positive maturity gap. If the result is negative, there is a negative maturity gap. Interpreting the maturity gap. Now, let's interpret the results. Positive maturity gap. A positive maturity gap indicates that the institution has more assets maturing before liabilities. Negative maturity gap. A negative maturity gap indicates that liabilities will reprice before assets. Zero maturity gap. A zero maturity gap suggests that there is an equal balance between interest-earning assets and interest-bearing liabilities maturing at the same time. Limitations of maturity gap analysis. While maturity gap analysis provides valuable insights into interest rate risk exposure, it does have its limitations. It assumes changes in interest rates affect all assets and liabilities uniformly, which may not be the case in reality. Additionally, it does not take into account the potential impact of cash flows during the gap period. In conclusion, maturity gap analysis is an important tool for financial institutions to assess interest rate risk. By calculating and interpreting the maturity gap, institutions can make informed decisions to manage their exposure and optimize their performance. Want to learn more? Claire Trithel on LinkedIn.